Hello, welcome to the A Book a Day channel. Today, I will be discussing a book titled How Much Am I?, which is the direct translation of its original Japanese title. The entire content of this book revolves around a valuation formula. The subject of valuation here is ourselves. We will discuss the specifics of this formula later. Let's first understand what valuation means here. We all know that human life is priceless, and the value of a person cannot be simply measured in monetary terms. However, it is undeniable that once we enter the labor market, we are governed by the invisible hand of market laws, and our value as labor is often objectively indicated by money. The value this book guides us to estimate is our value as labor, which is essentially our value in the workplace. The author of this book is Masato Noguchi, a famous MBA instructor in Japan and a big name in the finance industry. He has worked in companies like Reed Bank, JP Morgan, and Goldman Sachs, and later founded a consulting firm, which for 3 consecutive years ranked first in investment evaluation and M&A activities in the rankings released by a professional evaluation agency in Japan. In the 10 years following the establishment of his company, Noguchi handled over 2,000 cases of corporate value assessment. So, he is quite an expert in valuation. He states that although assessing the current value of a company requires complex logical reasoning, at its core, it's essentially a formula. The current value, PV, of a company equals the average future cash flow CF it can generate, divided by the discount rate R. Here, I must add, the formula provided by the author is based on a classic business valuation method, the discounted cash flow DCF method. The principle is to first estimate the future cash flows a company can generate and then discount these cash flows to the present. The strict calculation process is quite complex, involving segmentation of the company's growth stages, as well as determination of the company's growth rate, cash discount rate, etc. The formula given by the author here is a simplified version, but it essentially reflects the essence of this method. Let me repeat. The current value, also called present value of a company, equals the average future cash flow CF it can generate, divided by the discount rate R. Here, cash flow refers to the net amount of cash remaining after deducting cash outflows from cash inflows, which can be considered the company's profit. The discount rate measures the time value of money. With the discount rate, we can discount future cash flows to the present, determining their current value. This formula is not only applicable for valuing companies, but can also be used to assess the value of a business deal or an asset. The author believes that this formula reveals a fundamental truth. What determines a company's current value is not the amount of assets it currently has, but the future cash flows it can generate. This principle also applies to individuals. What determines a person's current workplace value is not what they currently possess, but what they can create in the future. This book uses this formula as a framework to explore how we, in the labor market, should correctly view our workplace value and how to effectively enhance it. The author discusses various common workplace scenarios, such as workplace interactions, promotions and raises, and opportunity choices. After listening to this book today, you will have a clearer understanding of how to make yourself more valuable in your future career development. Now, let's revisit this important formula. Present value, PV, equals the average future cash flow CF divided by the discount rate R. So, if we want to maximize our present value, we actually have 2 paths: increase the numerator or decrease the denominator. Next, I will explain along these 2 directions on how to use this formula to enhance your workplace value. Let's start by looking at the numerator, the average value of future cash flows. Obviously, increasing the numerator means enhancing our future cash flow period. There are 2 key words here. One is cash flow, and the other is future. Let's discuss them separately. First, let's talk about cash flow period. For many people, cash flow might be understood as the salary they receive each month. The author believes this understanding is incorrect. Think about it. Would a company value someone simply because they have a high salary? Certainly not. It's because of your value that your salary is high. The reverse is not true. So, what does cash flow refer to in our formula? It refers to the cash flow we generate for the company. It's calculated by subtracting cash outflow from cash inflow, which is the revenue you generate for the company minus the cost the company spends on you. And salary is included in this cost. From this perspective, the author reminds us, if your company increases salaries based on tenure, that is, based on years of service, don't get complacent. If someone's salary increases year after year without a corresponding increase in skills, they're likely to be the first to be laid off during tough times. Similarly, if someone receives a salary that doesn't match their abilities, it might seem profitable in the short term, but it's a dangerous situation in the long term. In the author's view, the safest survival strategy in the workplace is to ensure your abilities justify your salary. If you feel your current salary exceeds your abilities, or if you're dissatisfied with your salary, then strive to generate more cash flow to bridge the gap between salary and skills, or to improve your evaluation within the company. Hearing this, you might wonder, am I working just to generate revenue for the company? Why do I feel like I'm being used? The author says if you think this way, it's likely because you haven't properly utilized your company. Yes, not only can companies utilize their employees, but employees can also utilize their companies. How to utilize them? The author suggests thinking of your company as a huge toy box. In this toy box, there are tools, skills, equipment, networks, influence platforms, and almost everything else we need for our professional development. It's nearly impossible to gather all these on our own, but once we join a company, we can freely use these valuable resources to foster our growth. This way, you can turn your relationship with the company into a win-win situation. So, what kind of growth can the company's toy box provide us? According to the book, we can summarize it in 2 directions, and they are also the secrets to enhancing our cash flow. First is growth in thinking. Here, the author emphasizes the importance of developing a seller's mindset. A seller, as the name suggests, is the party that needs to sell something to others, commonly seen in sales departments of companies. However, in a broader sense, if you need to get more people to buy or agree with your product, idea, proposal, etc., at work, then you are in a seller's position. The author believes the biggest benefit of being a seller is that you get the opportunity to interact directly with customers. In today's world, where similar ideas, products, and services abound, to make a buyer think, I don't want others, I want this person's, you must have an added value beyond others. For example, you need to consider the buyer and every aspect of product design, keenly observe changes in their needs, pay attention to your attire, demeanor, and behavior when interacting with buyers, and constantly think about how to maintain existing customers and explore potential ones. However, if you're in the buyer's position, you don't need to pay as much attention to these aspects. A buyer is the party that purchases goods. For example, many departments in a company, like administration and procurement, have buyer roles. In the finance industry where the author works, fund managers are also called buyers because their main job is to spend investors' money in the financial product market. Buyers, being the more powerful party in a transaction, often think more from their own perspective, making demands of sellers, and are not adept at adopting the customer-oriented mindset of sellers. You might be confused, if I'm doing a buyer's job, shouldn't I just focus on my own tasks? Why do I need a customer-oriented mindset? In fact, customer-oriented means seeing everyone related to your work as your customers. This includes not only the buyers of products, but also partners in the company's supply chain, as well as colleagues, superiors, and subordinates. For example, for departments like finance, administration, and technology, their customers are the employees of the company. The author believes that whether you are in a seller's or buyer's role, to enhance your value, you must have a customer-oriented mindset. Often, the knowledge and skills we learn in buyer roles are only applicable to specific companies or positions. But this customer-oriented mindset is something you can use anywhere. For example, for a technical department, the internal users of a technical system are their customers. However, many technicians don't work with the mindset of serving customers. They just focus on completing tasks assigned by their superiors, without thinking about how can I make a more user-friendly technical system for my users. But because many people are in this state, those who are customer-oriented stand out. For instance, if a technician responsible for an internal system proactively identifies and improves a critical technical detail, reducing employee work time or cutting costs, the saved costs will be included in the cash flow they generate for the company. If a person continuously thinks about how can I provide a better experience for my customers, their work approach will be richer than others, and they can enhance their cash flow faster. This is the benefit of a seller's mindset, and it's not limited to specific industries or positions. Now, we've discussed the growth in thinking that we can achieve within a company. Let's move on to another type of growth in insights. We know that in a company, people usually focus on their own specific duties. However, the author believes that this is not enough. We should also look beyond our professional work to other areas. Most importantly, we should learn to overlook the entire business map of the company. What can this map tell us? First, it helps us clearly understand the functional positioning of our position within the entire company. The common positions we see can generally be divided into two categories based on their job content. One is generating income, and the other is saving costs. This is our starting point to enhance our money-making ability. For example, personnel responsible for maintaining administrative systems and internal technical systems are positioned as cost savers. They may rarely generate cash directly, but they play an important role in helping the entire company reduce costs and improve efficiency through various support works. Understanding this can give us a stronger sense of purpose and direction in our work. After clarifying our functional position, we should also grasp the value chain of our company, which means understanding the steps through which our company's goods or services reach the customers. This can help us more accurately assess our money-making ability. For instance, a company's sales department might have generated high profits in a particular year, but this achievement doesn't belong 100% to the sales personnel. This high profit is the result of the collective efforts of many, including procurement staff who purchase materials at low prices, R&D staff who develop groundbreaking new products, etc. If sales personnel forget these value chains, they are likely to overestimate their money-making ability. The same principle applies to other positions. Once we grasp the company's value chain, we can further place the company within its industry, understand its current industry position, its main competitors, and the company's strengths and weaknesses compared to them. This information can help us understand whether our department has strengthened the company's competitive ability or has been a drag in competition. If it's the latter, we need to identify where we're lagging and explore potential breakthroughs. Hearing this, you might say, "Aren't these things my leaders should be thinking about? Why should I worry about them?" Indeed. However, it's important to know that leaders won't tell us everything they're thinking. If we only focus on our own job, we will always be led by others in our thinking and actions. But if we proactively study the company's overall business and industry environment, we can prepare early for potential opportunities and risks. We can also use the current company as a research sample to gain an understanding of the entire industry and know what kind of development path we might have if we leave this company. This is the benefit of growth in insights. Okay, we've discussed the first keyword, cash flow, and how to use the company as a toy box to enhance our ability to generate cash flow, period. Next, let's talk about the second keyword in the average value of future cash flows, which is future. This word defines the direction of our efforts, which is to create an expectation among the people around us that you are someone who can make money in the future. The people around us include colleagues, superiors, peers, headhunters, etc. How can we make them believe that we can make money in the future? For those who have been in the workplace for several years, certainly, your past performance is more important. So, does that mean you need to achieve high performance every year? Not necessarily. The author says that in the workplace, those who are easily highly regarded are those with resilience. For example, you might have had a bad year with poor performance, but this year, you have made significant improvements in your work methods and shown a momentum that seems sustainable. Such employees may be more popular than those who have always been ahead. Back to the word future. Its biggest reminder to us is to manage others' expectations of us. Let's discuss a specific scenario. Suppose you have had a good performance this year, and you're thinking of asking your leader for a promotion and a raise at the end of the year. At this time, you need to manage your leader's expectations. How to do it? The author suggests that we should not start from our own interests, but from the perspective of to what extent I can increase the company's cash flow. For example, the least advisable approach is to directly ask for a promotion, saying things like, "I have achieved so much and hope you can appoint me as team leader." However, it's okay to ask for a raise at the right time, but it's best to prove with numbers that your salary is far lower than the cash flow you generate for the company. The most highly regarded approach is to show your superior how you plan to create greater value in the future. For example, I have achieved these results in the past few years, and I hope the company can let me handle bigger projects next time. Even when requesting a promotion, follow this line of thought. Don't emphasize what you want, but rather what you will do after the promotion and the value you will bring to the company. This way, our requests are more likely to be accepted. Alright, we've discussed how to increase the numerator of the value formula from the perspectives of future and cash flow. Now, let's look at the denominator, the discount rate. According to the formula, even if the ability to earn cash is strong, if the discount rate is too high, the value will not be high. Conversely, if we can reduce the discount rate, even if the cash flow earned remains the same, the value can increase. So, let's talk specifically about how to lower your discount rate in the workplace. In the financial world, the discount rate equals risk, growth rate, and this formula is also applicable to individuals. Let's first look at risk. From the formula, we know that the lower the risk of the cash flow, the lower the discount rate. How do we measure the magnitude of risk? Let's draw inspiration from businesses. Suppose there are 3 companies of the same size. I'll introduce their profit changes over 10 years, and you guess which one has the highest risk. Company A was initially losing money but then suddenly turned a profit, with a significant increase in profits. Company B's profits didn't change much over the 10 years. Company C initially had good profits but then saw a decline in profits, ending up in a loss. Many might feel that Company C, which is currently losing money, has the highest risk, and Company A, with increasing profits, has the lowest risk. However, from a financial perspective, both Company A and C have high risks, while the seemingly unremarkable Company B actually has the lowest risk. This is because risk is not danger but the uncertainty that can be anticipated in advance. Uncertainty refers to the difficulty of predicting future situations. Company B's net profit has been almost the same each year over 10 years, so we can infer that it's likely to earn about the same amount next year. In contrast, Company A has been losing money initially and only recently improved its performance rapidly. It may continue to profit next year, but it might lose money again the year after. So, when we talk about investing in a business with low risk, we're not saying that the business will perform well in the future, but that its uncertainty is low, meaning we can more easily predict its future situation. The author says that this applies to individuals as well. Some people might earn a lot when they can, but earn nothing when they can't. Compared to these people, those who may not earn big money but also don't make big mistakes have lower risks and are more trustworthy. Therefore, even if we don't earn a lot of money, as long as we can steadily produce results every year, we can also reduce our discount rate. Furthermore, if we want to create cash flow consistently and stably, rather than making a quick buck, we must work with a long-term perspective, not just focusing on immediate benefits. For example, a salesperson might coerce a customer into buying their product to meet their sales target. Although this temporarily boosts sales, the customer might end up resenting them and never return. Therefore, although earning cash flow early is important, if you want to lower your discount rate and reduce your uncertainty in others' eyes, it's even more important to have a long-term view in your work. Other factors also affect your certainty in others' eyes. For example, maintaining emotional stability in adversity. Some people are very mild-mannered normally, but lose control when they are punished, when results don't meet expectations, or when under tight deadlines. The author says, don't think that people around will understand you. They are actually observing you calmly. Even if your situation is sympathetic, the impression of emotional instability will still be vividly remembered. If a person can remain emotionally stable in adversity, people around will feel that this person is professional and reassuring. In other words, your certainty is relatively high. So always remember, the more you are in adversity, the more you need to control your emotions. A similar viewpoint is presented in the book I previously interpreted for you, Manage Yourself Like a Business. It says that even if you feel like you're in the winter of your career, as long as you're in the workplace, you should try to maintain the rhythm of spring and the smile of summer. For example, still meet with colleagues energetically, still report to your boss as usual, and maybe report more. In short, even if winter is coming, continue to do what you should do, which will earn you an additional label of calm in change and strong professionalism. Okay, The above-mentioned maintaining emotional stability can enhance your certainty in others' eyes. Now let's talk about a behavior that severely weakens certainty, which is hiding or deceiving in work. The author witnessed a trader who, to make his performance look good, hit a losing trade. When discovered, he said he just forgot to report it. Later, this trader was dismissed by the company, not because he caused a loss to the company, but because he first hid and then lied about the loss. This reflects a fundamental problem. He is not a trustworthy person. You don't know what more he might do in the future, and you even doubt whether his past performance was real. Such examples are not rare in reality. You might have seen firsthand how some people, in an attempt to cover up a mistake at work, foolishly lie and ultimately ruin themselves. Actually, not only obvious lies count as deception, many people might have slightly deceived others or spoken ambiguously. For example, some salespeople might know they can't fulfill a customer's request but still respond with "Okay, we'll do our best," or "We'll definitely try to complete it." The author believes this is also a form of deception. The customer might wait with high hopes, feeling their request will likely be fulfilled. When they finally realize it's unachievable or far from expectations, their trust in the salesperson will greatly diminish. From a financial perspective, honest people have lower risks because they can minimize information asymmetry between parties and strive to create a sufficiently transparent information environment. The more information is shared, the higher the certainty of predictions. The same applies in the workplace. To avoid unexpected losses, companies need to gather as much information as possible. Dishonest people are uncontrollable unknowns in the information environment, significantly increasing the company's operational risks and becoming potential risks themselves. Alright, we've just discussed the first key factor affecting the discount rate: risk. Remember the formula for calculating the discount rate. Discount rate equals risk, growth rate. So, the second key factor we'll discuss is the growth rate. Let's recall the three companies I mentioned earlier. Company A's profit changes involve starting with continuous losses, then turning to profit, followed by sustained growth. Company B's profits remained relatively unchanged. Company C initially saw rising profits, then a decline, and eventually ended up in a loss. Now, if we rank these companies from the perspective of growth rate, it's clear that Company A, which turned losses into profits, should have the highest growth rate, followed by Company B, and Company C, which went from profit to loss, would have the lowest growth rate. The same principle applies to an individual's discount rate. Even if a person's past cash flow has been unstable and the risk relatively high, as long as the trend is upward, their growth rate will rise. Consequently, their discount rate will decrease. At this point, a careful listener might wonder, since both risk and growth rate are key factors affecting the discount rate, what should we do when they conflict? For instance, imagine a scenario where your company decides to embark on a challenging new project. If successful, it could yield high profits, but if it fails, it might also result in significant losses. Your leader approaches you, hoping you'll take charge of this project. Should you accept? The author's advice is to accept. Why? Let's first think from the perspective of a business, then apply it to individuals. For a company, not taking any risks is like depositing all its funds in a fixed-term bank account. Indeed, this approach ensures very stable returns. But would such a company be attractive to investors in the market? Obviously not, because it shows no growth. The same applies to employees. Some people, in an attempt to ensure the stability of their cash flow, excessively avoid risks and fall into a defensive work state, focusing solely on playing it safe. However, this approach does not promote personal growth. Moreover, from the company's perspective, such employees who cannot take charge during crucial moments are naturally seen as less valuable. Therefore, whether from the perspective of personal growth or company development, we need to actively identify opportunities and bravely embrace challenges. However, it's important to note that the author is not encouraging us to blindly take risks. He believes that the risks we can take are those where we clearly understand how much we can earn if things go well, and how much we could lose in the worst case. Knowing this allows us to weigh losses against gains and make informed decisions. This is similar to the investment approach. As Warren Buffett said, multiply the probability of loss by the amount of possible loss from the probability of gain by the amount of possible gain. That is what we are trying to do. This principle, a cornerstone in investment, can also be applied in many of our decision-making scenarios. For instance, if you're hesitant about spending $10,000 on a self-improvement course if the expected return from it exceeds $10,000, then it's a worthy investment. Similarly, when hesitating about taking on a project, if the expected benefits outweigh the potential losses, you should take it on. Of course, while taking on the project, you should also show your leader your calculation process, involving 4 key figures: the maximum amount of loss, the probability of loss, the maximum profit, and the probability of gain. The author believes that among these, what we should emphasize the most is the maximum possible loss, the worst-case scenario, albeit with a low probability. If the leader finds this acceptable, then even if the project fails, since you've already given a prior risk warning, you wouldn't have to bear all the responsibility alone. Conclusion. So, we've discussed how to enhance personal workplace value according to the value formula, both by increasing the numerator and decreasing the denominator. To recall, an individual's current workplace value, PV, equals average future cash flows, CF percent discount rate R. To increase the numerator, grasp 2 keywords: cash flow, reminding us to utilize various resources in the company's toy box to enhance our ability to earn money, and future, reminding us to manage others' expectations of us, aiming to improve their assessment of our future money-making capabilities. To decrease the denominator, focus on 2 keywords: risk, where lowering the perceived risk in the eyes of others involves being a person of high certainty, and growth rate, which requires seizing opportunities and bravely undertaking manageable risks to increase our future growth rate. That's our discussion for today. One final thought to share: while any asset can depreciate, only human talent has the potential to continually appreciate. In this ever-changing era, let's remember this value formula and hold onto the fundamental principles to win the future. That covers the essence of this book, and I encourage you to read the original for further insights. Feel free to share this video with your friends. Congratulations, you've completed another book.